This is Trading Lesson 49, delivered by Twigbe Ehizugi for Forex, crypto, stock, options, bonds, and other chart-related traders. Advice to subscribe, share, likes, and make comments. You can contact us for account management, training, consultation on +234 803 7597 085. And you can also check our previous posts on, for example, on how we turned $3,000 to over $400,000 in about 4 months, as well as our technical analysis trades. When there is a trend, look to enter with trend on a pullback, like a high 2 in a bull trend or a low 2 in a bear trend. Also, after a strong trend line break, look to enter counter trend on a test, like a higher low or lower low in a possible new bull trend, if there is a strong reversal bar. Price action works on any time frame and any type of chart. All charts show the same behavior. It usually has to have been at least 2 consecutive strong bull trend bars before most traders will believe that the always in direction is long, and at least 2 consecutive strong bear trend bar before they will think that the always in is short. However, if the context is right, even a single trend bar with an average range can be enough to make traders believe that the always in position has flipped to the opposite direction. Since a second trend bar is usually needed for traders to believe that the always in position has reversed, the close of that trend bar is important. For example, if there is a bear breakout bar, then traders will carefully watch the close of the next bar. The bears will want a bear close and the bulls will want a bull body. The market has inertia, so most attempts to change what it is doing will fail. This means that many traders will buy the close of the bear breakout bar, expecting that the follow-through bar will have a bull close and the bear will give up. If the breakout is not too strong and there is a good reason to believe that the breakout should fail, like a breakout attempt at the bottom of a bull flag, this can be a good trade. But because the decision is difficult, only experienced traders should consider it. The bulls want to buy pullback, so they look for bear spikes to fade. They see a bear spike as a commitment by the bears who are on the wrong side of the market, and we therefore have to buy back their shorts with losses. Also, bears will not look to sell again for at least a bar or two, so there will be fewer bears coming into the market. This increases the chances that the bulls who bought that bear spike will make a profit. If the follow-through bar is strong, traders can enter on the close of the bar or on a small pullback. For example, if there is a strong bull breakout and the next bar is a strong bull trend bar, many traders will buy on the close of that follow-through bar or on a 1 or 2 tick pullback. If the follow-through bar is weak, like a doji, it is usually better to look to buy pullbacks rather than close of the bar. If the follow-through bar goes only a few ticks beyond the breakout bar, odds favor a fade breakout. If it goes many ticks beyond the odds favor the bar becoming a strong trend bar once it closes. In general, whenever the market is always in long, traders will look at every attempt by the bears to turn the market down as a buying opportunity, because they know that most attempts to reverse a trend will fail. They will buy at and around the close of any bear trend bar at and below the low of the prior bar or any prior swing low, and below all support levels like bull trend lines. Since you are swinging during always in trading, you have to allow pullbacks, which are inevitable. Most pullbacks are not reversal entries, so you cannot allow yourself to be constantly worrying about every move that is against your position. In general, if there is a pullback that would have hit a break-even stop, and then the market resumes in your direction for several bars, you should not come back to your entry price again. Therefore, in most cases, you could then move your stop to break even. If it is hit by that second pullback and you are not certain of the market direction, just remain flat until you feel comfortable with another always in setup. Remember, uncertainty is a hallmark of a trading range, and always in is an approach for trend. When the market needs one more bar to flip the always in direction, traders often fade the move, expecting that bar to not materialize, because they know that most attempts to flip the direction fail. Traders will generally exit a trade on a signal in the opposite direction, even if that signal is not strong enough for them to reverse direction. Remember, it takes less to convince traders that it is time to exit a long than it does for them to take a short. When the market gets within a tick or so of a magnet, traders do not feel confident about the test unless the market gets that extra tick and actually touches the magnet. Until that happens, they usually will not aggressively trade it as a completed pullback.